While global growth forecasts for 2022 have been revised up slightly over the last quarter, those for 2023 have been revised down from 2.5% to 2.1%. What's going on? First of all, central banks globally have been tightening policy. Secondly, business confidence surveys have generally told a story of a contraction in activity. But on the other hand, job markets remain extremely strong. The unemployment rate in the United States is the lowest since the 1960s. And in the Eurozone, unemployment is at the lowest level on record. And also, importantly, China is in the process of reopening, and that will provide a massive boost to global growth in 2023. So these factors should balance each other out. Slow down in confidence on one hand, China boost and strong job markets on the other, leading us to anticipate steady but low levels of growth in 2023. Turning to inflation. As we expected, headline changes in prices have begun to turn lower, thanks in great part to the decline in energy prices over the last 12 months. But core inflation, which strips out food and energy prices, remains elevated, and workers are calling out for higher wages, and wage pressure is likely to keep inflationary pressures elevated. Inflation in the United States and Europe we expect to remain well above the target of central banks. Let's turn now to central banks. The message from the US Federal Reserve could not be clearer. Rates will remain higher for longer than is expected by the market. In Europe, there was a very hawkish turn in European Central Bank policy in December. The ECB expects significant rate hikes at a steady pace, which is more than was priced in by the market, and importantly, the ECB is set to begin to reduce the size of its asset holdings from March onwards. The Bank of Japan has shifted the bands within which it allows 10-year government bond yields to trade from 25 to 50 basis points, and could even increase them further. This is the first step towards policy tightening in Japan. The People's Bank of China, on the other hand, continues with a very easy monetary policy and will not change until such time as reopening begins to show an impact on inflationary pressures. All in all, rates set by central banks will remain below the level of price increases, and our advice to investors is clear. Don't fight the ECB and don't fight the Fed. Regarding fixed income markets, as we expected, the yields on 10-year treasuries did rise above 4%, only to trade lower to around 3.5%. But the Fed remains committed to higher rates, which will put upward pressure on bond yields. In our view, the best opportunities are to be found in short-dated US treasuries, given the inversion of the yield curve. The uptrend in European bond yields remains intact. The ECB surprised markets with its hawkish turn in policy, and key rates remain well below the extremely uncomfortable levels of consumer price inflation. Here too, we'd expect rates to move higher. Turning now to corporate credit markets. There was a sharp reversal in the fourth quarter of 2022 as risk appetite returned with a vengeance, bringing credit spreads much lower than they were at the end of the third quarter. We continue to find opportunities in high quality, short-dated corporate bonds and in subordinated financials, which offer high issuer quality and relatively high and attractive yields. Turning now to currencies. The blow-off top we saw in the dollar index at the end of September did not last, and the dollar has turned quite decisively lower. Traders are betting that the Fed will shift to a much easier monetary policy, while other central banks, notably in Europe, will tighten theirs, reducing the interest rate differential. On the other hand, the euro remains extremely undervalued, and with the worst fears about energy crisis in Europe having been dispelled over the last couple of months, we feel there is still upside for the euro against the dollar. In commodity markets, this year will be dominated by the reopening of China, which is the single largest consumer of most of the commodities produced in the world. That suggests to us, given constraints on supply, that prices for energy and industrial metals will rise this year. Gold prices have been supported by massive buying by central banks, particularly in the emerging world. They bought a total of 673 tons of gold in the fourth quarter, the highest quarterly total since the 1960s. With bond yields having come lower and such massive central bank buying, we think the environment remains positive for bullion. We increased exposure to equities in the fourth quarter to take advantage of the pickup in risk appetite. But we remain defensively positioned. Indeed, the increases we made were in areas such as Europe and value stocks, which are relatively defensive compared to other parts of the market. Looking ahead, we think that analysts are too optimistic about the prospects for earnings growth, given the slowdown we see in business confidence across many economies. Europe still looks relatively attractive, trading at 12.4 times 2023 earnings, but the US remains quite expensive at 17.8 times. So we stick with a preference for Europe over the US. So let's sum up with our key convictions for 2023. First of all, we remain underweight fixed income, and within bond markets, we focus on short-dated treasuries and corporate bonds where we find the value, as well as subordinated financials. We also remain underweight equities with a focus on areas such as Europe over the US. We prefer value stocks to growth stocks. We continue to like areas like energy, given the outlook for oil prices, and we also focus on beneficiaries of the reopening of the Chinese economy. In terms of commodities, we stay neutral for now, but we're looking for opportunities to move overweight. So overall, the message is pretty well unchanged from last quarter. We remain relatively defensively positioned given the complexity of today's economic and market environment.